Hey everyone, this is Michael, and this is the Market Trend Advisory Report for February 27, 2022. Well, this week a lot went on, and so we want to just go over the current market trend overview. Before I start, just wanted to say that the content and information in this presentation is provided for educational and informational purposes only, and should in no way be considered investment advice. So let's go ahead and take a look at the current market trend. Despite the huge rally we've had in the last couple days on Thursday and Friday, we're still in a market in downtrend and a market in correction. So our system has no positions for either the indexes or individual stocks or non-index ETFs. The market count for both the S&P and Nasdaq is at 0. We have 0% exposure, and we're currently not counting the institutional selling days just because we are in a correction. And our power trend is off. So at this point, the market, and actually our buy signal, our buy switch, is also off. So according to the system, you shouldn't have any exposure to stocks, and you should be out and just waiting for a follow-through day. So what I'm going to do is go through the next couple charts, go over what the trend looks like on a. First, let's start with a bigger stage. So this is a Nasdaq monthly chart. Unfortunately, I can't zoom in on this chart, unfortunately, but you can see we've shown this one quite a few times. Here on the left, you can see we had the big run up during the internet bubble. We had the blow off top in 1999 and 2000, and then we had the crash, which was over 80% from March 2000 all the way down to, I think it was September or October, something like that, in 2002. So, but what I wanted to point out is you can see that we have this channel that's been in gray, and you can see that we basically touched it, stayed below it. At times it formed resistance, like over here, but then starting in 1998, we started moving into that channel, and then we broke out of it, which was showing that the market was just getting hugely overextended and ahead of itself. And then it stayed up out there for about a year and then broke below it. So if we fast forward to today, we had a similar channel that kind of contained the market for a long time. We had quite a few times where here in 2011, we sort of hit the top of it. Market was getting a little overdone. It came down. We found support near the bottom. Came back up a few times. We hugged it for a couple years here, 2013 and 14, came down. And then we definitively broke above in 2020, and we've stayed above actually longer than a year. But again, what this is showing is the market's just overextended, and it's gone past its normal standard deviation, if you want to look at it from that point of view. And what happens is when markets extend too far one way or the other, they end up pulling back, and many times will pull back and go below where they actually started. So this is the situation we find ourselves now. You can also see in both charts, here we went above in 2000. Our trading volume just exploded higher, and of course you can look what happened since 2020. We have huge volume. So that's the big picture. Now we've also just hit support at this moving average. I think this is a 40-week. No, actually, it's not the 40 week. So I don't know offhand what that moving average is, but we're getting support right there, which is a good sign. And we're also at the very top of that channel. So the markets, even after the big plunge we had and the huge run, we're still just right at that spot. So we're kind of at an inflection point here of where it's going to go. Let's look at the same chart in the S&P. Now you can see back in the internet bubble days, the S&P just a few times got above this channel and then was sold off. And by the end, it didn't even hit the top of it, and we had its bear market that happened. Here we didn't go up as much, but we did come up above it for, I think it was 8 or 9 months, and then we've come down, and we're not even at that same moving average, but we're sort of back at the top of that channel. So it's a little ominous just from that point of view of the market has gotten so extended, and the market has never stayed above that channel and just kind of got support and then just kept going. We do see back here, I'm back in the Nasdaq chart, we had the initial crash off the highs in 2000, and then we rallied right back up, and we got the same support at the top of that channel. And kind of, you can see the bottoms of a lot of these months were coming down to the channel and then getting support, and then we finally broke. So here we, very easily could have a rally back up, and more likely than not, we're going to break this and head lower. But that's just speculation. The market can do anything, and will surprise most people most of the time. And here we're back in the S&P. We're back there, so I wouldn't be surprised to see, especially with the powerful rally we had on Thursday and Friday, for it to head up a little bit higher. So let's take a look at the Nasdaq now, just in the daily chart, and you can see this huge reversal we had on Thursday. This reversal was 886 points, and it was the largest 1-point gain measured from the opening to the close, because we just opened way low, gapped down, and market immediately just turned up and went straight back up. And so that was the biggest 1-point gain from open to close since the data has been collected in 1971. And so that's over 50 years. It was a pretty incredible day, but you do get these kinds of moves in bear markets. So not surprising, but this one was an exceptional one, and we had huge volume on top of that. I know on that day I looked at some of the stats, and Tesla alone gained $100 billion in market cap. It's just kind of crazy numbers. And but even so, you can see even with the 2 days of rallying, we've only just come back to the 10-day moving average, and all the moving averages are heading lower, and they're trending lower. And the 200-day is it's flattened out, and if it continues down here, we'll actually curve down, and that actually ends up being what's called a stage 4 decline, and that's when the market just heads lower, pretty much solidly and regularly, just can't rally and just keeps going down. That's sort of the final phase of a market, but we'll see what happens. The market's probably going to try at least to test its 21-day. That's the green line, and may even make it up to the 50. That's going to be the big the challenge line, where the bulls and bears will have to fight it out, and we'll see what happens there. Let's look at the same chart for the Nasdaq on a weekly. On a weekly, I mean, even though we had that huge run, it had a nice close. You can see we closed right at the top of it. We're still right at the bottom of the correction that's happened, and hasn't really proved anything. And the weekly volume wasn't even very strong compared to its 50-day weekly average. So on the surface, it looks super bullish, but we'll see what happens. The other thing too is that overnight, as I shoot this is on Sunday late afternoon, and the Dow futures are down 500 and the Nasdaq's down 350. So the market's still in the process of reevaluating what the Russia-Ukraine conflict really means, and so we may not just continue straight up unless very bullish news comes out of that. So let's take a look at a couple more things, and I'll wrap it up. We've looked at this chart a few times. It's just the percentage of Nasdaq stocks above the 200-day moving averages. We're still down only at 21%, which is actually saying that about 80% of stocks are below their 200-day moving averages. So, and that's been trending down for over a year. Really pretty bearish under the surface. And here's the same thing with the S&P, and we're about 50-50. We had a pretty big run just in the last few days. We were down under 40%. We're back about 50%. So I guess if you wrap it all up, it's just a lot of cross currents going on. The Ukraine-Russia conflict has just taken center stage. Seems like the market is not really worrying about inflation or interest rates. That's all in the back burner. And so I think just for right now, we're going to have to expect very volatile, day-by-day, news-driven movements in the market as it digests each day and tries to figure out what it's going to mean. But interesting, geopolitical events really haven't had a significant long-term impact on stocks. And many rallies have started on the announcement of attacks or diffusing of the situation. So I have a little chart here just of a lot of events that have happened over the last 50, 60 years. Really, it just kind of putting it all together. A lot of times we haven't seen the one-day event. It really has just been under 2%. The total drawdown, this is for the S&P, has been averaging of 5%. The bottom came about 22 days out, and the recovery was 47 days later, till the market has made made back all of its loss. And the important thing to know is that it's the fear of what's going to happen that drives the market down. When the event actually happens, as we saw just on Thursday, that's what usually turns the market around. So that's sort of an interesting thing that hasn't really had much of an impact over time. But the market's always trying to figure out what is it going to mean for the U.S. economy, and that's why sometimes it can just come rip roaring back, as we saw with the coronavirus crash. It quickly determined that, which nobody can really figure out how it knew, but that's how the markets work. Probably had a lot to do with just the trillions of stimulus that was pumped in, that it wasn't really going to affect, on balance, all the publicly traded corporations, even though of course it did, and for many of them, but many such as Microsoft and Apple and others really didn't see any kind of hit to their business. So we just saw a straight up movement in the market. So the things that we sort of be looking at going forward too is that, and this is what the market's trying to figure out, is what is the impact going to be. And I think we're going to see the impact on the U.S. This conflict continues. It's going to be higher gas prices, higher commodity prices, and probably supply chain disruptions, even though we've already seen that for over a year. And all that added together adds up to higher inflation. So it's one of the things the market's already grappling with. If this conflict continues to go on, that's probably going to exacerbate the inflation picture, and we'll get even higher numbers than what the market really wants. And the other part of it too is that if oil just continues to hold over $100, that's going to start impacting consumers' behavior and will probably start affecting the stock market also. Again, in the futures market, I think oil was up 7%, so we're actually pretty close to $100. So a few other things to talk about here. With this under the surface, even with the market making these big moves, 81% of Nasdaq stocks are below their 200-day moving averages. More than 50% of the S&P is below their 200 days. 76% of Nasdaq stocks are in bear markets, and 51% of S&P stocks are in bear markets. And the last two stats are from Bank of America, who's expecting, I think, another 13% decline this year. And really, they're probably one of the more bearish major institutions. But that's where they are. There's quite a few that are still saying we're going to be much, much higher than where we are. I mean, in the end, nobody really knows. That they don't know. They can just make their sort of educated guesses, but that's where it is. So the final couple things, as we all know that the inflation rising and is rising, and the rates are rising. Ultimately, that if it keeps going, it's going to lead to growth slowing, which leads to deteriorating fundamentals in the economy, and that equals negative returns in the market. So that's what the market's trying to figure out. And so far, it is not seeing the same fundamentals and that they've been seeing for many years, and also the fact that the Fed may not be able to provide its quote unquote Fed put, where it just would perceive that they will jump in to support the market when things get ugly. That may not be something that is going to be continuing. If in fact it was something that was real, I actually personally believe it was. Some of the movement I've seen just over the decades in the market, it just seemed like some concerted effort somewhere in the big players happened behind the scenes to all make them come in at the same time, especially even on Thursday. Like, nobody knows what made basically all the institutions, everyone just start piling in from Monday morning. But that's more speculation, and we'll see. So nobody really knows. The other thing that we've also starting to see under the surface is that the housing stocks are starting to really, and related companies are starting to really perform pretty poorly. and maybe forecasting recession, which is what the market is concerned about. Home Depot, one of the giants, is down 29%, and Toll Brothers, one of the big home builders, is down 38%. So again, it's another cross current of what's to come. I think really just to wrap it all up, probably investors' expectations should be, pretty well tempered down at this point. I think unless something majorly changes, which doesn't look likely, probably the expectation is for down to probably on the better end, flat year. But we'll see. We're just guessing what can happen in the future. But these are some of the things that are center stage right now, and we'll see more. So this week we'll come back, and next weekend, and I'm sure there'll be a lot more major moves and excitement that's gone on, and we'll provide the next look at the trend. But again, right now the trend is down. We are still under the marketing correction. We're actually on, I didn't mention this, sorry, I left this part out. Going back to the Nasdaq chart, you can see here we broke below this low here, and we came back up, and we're actually on day 2 of a rally attempt. And historically, we're looking for a follow-through day on day 4 or beyond, and that's something that is sort of necessary for the market to sort of find its footing. It doesn't mean that if we get a follow-through day, the market's going to take off and we're in a new bull market, or at least a major rally. But no bull market has ever started without the follow-through day. And the reason why we usually wait a few days is that you're trying to avoid the fake outs, where the market starts a rally, everyone gets piling in, and then it just rolls over. This kind of which was invested by Investors Business Daily, does historically over many decades has proven to work really well in kind of keeping you out of the market when it's not really established in terms of any uptrend. And so we'll see. So we're day 2. It looks like Tuesday could be the first day we could get a follow-through day. Again, it doesn't mean that we're off to the races. That's why the system, when we do start getting signals, we creep in. The first a market count of 1 is 30%, then it goes to 55%, and we'll take it from there. So, but it looks like Monday morning we may have another down opening, but of course the futures vacillate all over the place. So by Monday morning, tomorrow morning, we could be up 500. So you never know with the market. So that's about it for today, and we'll see you on next weekend. All right, thanks.